back to India Business Insights, and here's our new video on Double Taxation Treaties, where we talk more about the Double Taxation Avoidance Agreements and how they function. Double taxation refers to circumstances where a taxpayer is subject to tax on the same income in more than one jurisdiction. For example, a resident of India who is also considered to be a resident of the UK would be potentially subject to concurrent full taxation in both the countries. When individuals or businesses are involved in cross-border transactions, it is essential to considerably understand the likely tax and compliance implications involved in a transaction. This is the reason countries have bilateral tax treaties, where they generally tend to eliminate or at least reduce the possibility of double taxation. All double taxation treaties are international agreements. They are mostly bilateral in nature, with an exception of a few multilateral treaties that are currently in existence. When a taxpayer is subject to tax on the same income in two states, treaties such as this help to minimize double taxation. They help to provide a degree of certainty for the tax treatment of cross-border transactions. They prevent tax discrimination against taxpayers of different states. For the purpose of free flow of international trade and investment, it is essential to remove or mitigate tax as a barrier. The treaties help to share and exchange best case practices between different countries, and moreover, these treaties exist for the smooth and successive flow of cross-border business activities. More than 3,000 bilateral tax treaties are currently in effect in the world today, and most of these treaties are part of the United Nations Model Convention or the OECD model. As per the Vienna Convention on the Law of Treaties, here are a few interesting facts one should keep in mind regarding tax treaties. Firstly, tax treaties are often called either agreements or conventions. Secondly, bilateral tax treaties confer rights and impose obligations on the two contracting states, but not on third parties such as the taxpayers. Thirdly, the treaties are binding on the contracting states and must be performed by them in good faith. This is based on the Pacta Sunt Servanda principle. Double Taxation Avoidance Agreement (DTAA) is a tax treaty signed between two or more countries to help taxpayers avoid paying double taxes on the same income. For NRIs who are working in other countries, the DTAA helps to avoid paying double taxes on income earned in both their country of residence and in India. For example, Mr. A is an Indian citizen residing in the US. He has made investments in India on which now he earns returns. Now, according to the law, this income can be taxable in both India and the US. But because of an existing DTAA between India and US, Mr. A will not be taxed in both countries for the same income. The DTAAs are based on four models: the OECD Model Tax Convention, the UN Model Double Taxation Convention, the US Model Income Tax Convention, which is followed only when entering into DTAAs with the USA, and finally the Andean Community Income and Capital Tax Convention, which is adopted by certain states only. As far as India is concerned, its DTAAs are guided by the UN Model Convention. These agreements are made to allocate jurisdiction between the principle of source as well as the principle of residency. Presently, there are 85 plus countries with which India has signed a DTAA with. The agreement prescribes a maximum rate of taxation to be charged in the source country, which is generally lower than the rate of tax prevailing in that country. Further, Sections 90 to 91 of the Income Tax Act of 1961 deals with double taxation relief. Here are a few relevant judgments regarding the standing of DTAA in India. The High Court of Andhra Pradesh in CIT vs Visakhapatnam Port Trust held that the provisions of DTAA are a part of local tax law, and that if something is taxable under the local law but subject to avoidance of tax under these agreements, the authorities are duty-bound to give effect to the agreement. Later, with respect to the effect of DTAA, the Karnataka High Court in R.M. Muthaya held that the effect of an agreement would be that no provision of the agreement or article can impose a levy where the liability is not imposed by the IT Act, and if a tax liability is imposed by the IT Act, the agreement or article may resort to reduce it. In case of a difference arising between the IT Act and the agreement or articles, the provision of the Income Tax Act will prevail. Later, the Honorable Supreme Court upheld this ruling in Union of India vs. Azadi Bachao Andolan in 2003. There are two kinds of DTAAs, comprehensive agreements and limited agreements. Comprehensive DTAAs are agreements involving all sources of income. Some of the countries with which India has comprehensive agreements include Australia, Canada, the UAE, Germany, Mauritius, Singapore, the United Kingdom, and the United States of America. Whereas limited DTAAs cover only certain areas such as income from operation of aircrafts and ships, estates, inheritance, and gifts. There are two ways of implementing double tax avoidance agreements. First, by either exempting the income earned abroad in its entirety, or second, by providing credit to the extent of tax already paid in the other country. Continuing the previous example, since Mr. A is covered under the DTAA and the agreement states that US will exempt his entire income earned on investments made in India, he will then have to pay taxes only in India and not the US. Therefore, only one country will charge his income. Say in another scenario, let's assume the agreement states that both India and US will charge taxes on that income. In this case, Mr. A will get a credit of the taxes paid by him in the US, which will be deducted by paying taxes in India. Consequently, he will end up paying taxes in both countries but at a lower rate. And for this reason, double taxation avoidance agreements exist in order to provide such relief to the taxpayers and therefore encourage more investments. How can an NRI claim benefits under a DTAA? Non-resident Indians residing in any of the DTAA countries can avail tax benefits provided under the agreement by timely submission of the following documents every financial year to the concerned authorities. First, a tax residency certificate. To obtain a TRC, you can approach the tax or government authorities of your current resident country. Second, Form 10F. Third, a self-attested PAN card copy. Fourth, a self-attested visa and passport copy. And finally, PIO proof copy if applicable. How does one claim tax relief under the DTAA? If a DTAA exists with a particular country, then tax relief can be claimed under Section 90 of the IT Act. For example, Mr. A resident, earned income in India of Rs 4 lakh. He also earned income from a foreign country of Rs 1 lakh. So how much tax relief can he claim and how much tax does he actually pay? The relief shall be calculated as follows. His global income is Rs 5 lakhs. Tax on his global income is Rs 12,500. The average tax rate is 2.5%. The tax required to be paid is Rs 2,500. The tax paid in a foreign country is Rs 10,000 on his income of 1 lakh. Therefore, the amount of relief shall be lower of steps 4 and 5, which is Rs 2,500. Moving on to when there is a DTAA with the specified associations, where tax relief can be claimed under Section 90A of the IT Act. When a specified association in India enters into an agreement with a specified association abroad, the central government may adopt such an agreement and can provide relief under Section 90A of the IT Act. Relief can be claimed only by the residents of the country who have entered into an agreement with the Government of India. If residents of other countries want to claim the relief, then they have to obtain a TRC from the government of that country. Now, what happens when there is no DTAA? In this case, tax relief can be claimed under Section 91 of the IT Act. Section 91 shall apply if the country in which tax is paid has not entered into any agreement with the Government of India. Further, when there is no bilateral agreement in such cases, a unilateral agreement applies. The following are the steps to compute relief under Section 91. First, calculate the tax payable in India. Second, compare the Indian tax rate and the foreign tax rate. Third, multiply the lower tax rate with the doubly taxed income, and the relief will be the amount as computed in Step 3. For example, Mr. B has a doubly taxed foreign income of Rs 1 lakh when the tax payable in India is to be calculated at the rate of 30% and the foreign tax rate is 20%, then the relief would be as follows. The tax payable in India is 1 lakh into 30%, which is Rs 30,000. Lower tax rate between 30 and 20 is 20%. The relief shall be 1 lakh into 20%, which is Rs 20,000. Therefore, if you or your company is currently doing or intend to do business abroad, it is important to stay in the loop regarding your taxes in order to prevent double taxation and to further claim the accurate relief under these agreements. India, being a powerhouse, has signed multiple double tax avoidance agreements with most major nations where Indians currently reside. I hope this video was useful to you and stay tuned for more such videos.